Hi, everyone, and welcome. Thank you for joining us for today's Meet the Analyst webinar, Retail Media by the Numbers, an analysis of our latest ad spend forecast. I'm your host, Paul Verna, Principal Analyst at Insider Intelligence based in New York, and I'm joined by my colleague, Senior Analyst Max Willens, who's in Philadelphia. Hi, Max, great to have you here.
Thanks, Paul. It's nice to be here.
So before we get into the main presentation, I'd like to thank Criteo for making today's webinar possible. And I'd like to welcome Mike Greene, Senior Vice President of Global Vertical Strategy at Criteo. Michael is joining us from Charleston, South Carolina. Great to see you again, Michael.
Good to see you, Paul. Glad to be here today.
Happy to have you. So a few things before we dive in. We have a ton of information to share, but there's no need to take notes if you'd rather not. We'll email you a link to view the slides and the full recording of today's presentation. But we do want you to participate. So just use the chat window on the right of the video feed to submit questions at any time during the presentation. We'll get to as many as we can during the Q&A at the end of the session. So with that, Max, let's get started.
Thank you, Paul, and thank all of you for being here today. I'm really excited. This is one of the, I think, most important forecasts that we publish every year, and I'm glad to be sharing it with you guys. I don't think that it's an exaggeration to say that retail media is one of the most important and potentially most transformative ad spending channels in media right now, and the most recent forecast that we put together has a ton of really powerful numbers that we're going to go through today. We're going to, of course, start with top line numbers, but we'll also look at the kind of factors behind retail media's growth, the formats that are supporting that growth, some of the things that are going to feed its evolution, and we'll also look at, a couple of things that are hindering it, however lightly. But without any further ado, let's talk about the third wave. So what you see here is a chart that I'm sure a lot of you have seen in the wild already. Some colleagues of mine put it together about a year ago. A lot of different news organizations have shared it. Our own newsletter and briefings team has shared it. And it communicates a really powerful truth. There are some caveats, which I'll dive into in a moment. But the reality is that it took retail media just 5 years to turn into a $30 billion ad spending business. And it did that in less than half the time it took social media to achieve that milestone, and in nearly a third of the time that it took search ad spending to do the same. Again, to the caveats, it's obviously a lot easier to scale a digital ad business in 2016 than it would have been in 2002. And the sizes, if you're wondering about the sizes of these waves here, this graphic lumps retail media search into retail media rather than search. So the black wave at the bottom should be a little larger, but I start with this wave basically to illustrate the rapid growth that has characterized the start of retail media, but also to speak to why this is happening. So retail media right off the bat ticks three very important boxes for marketers today. First off, the ads and the targeting that power them sit on top of privacy compliant, very rich first-party data that the retailers take very seriously. It's close to the transaction and performant, especially in its current format, which is very important for outcomes-oriented advertisers and marketers. And it already has or relies on and taps into scaled relationships between buyers and sellers. So just as an example, in the fourth quarter of 2022, eBay announced that it had more than 2 million advertisers on its RMN, and they are, a big player in this space, but certainly not the biggest. And there are plenty others that have lots of similar dynamics in place. So you combine this, critical set of factors with the breakneck growth, and what that adds up to has been a lot of very excited, occasionally euphoric sounding coverage of this space. And a lot of it is justified, but before we get too carried away, I do want to throw maybe not a bucket of cold water, but a couple droplets of cold water on the space. So what you see here is a pair of forecasts that our team has published over the last year and change. We update our retail forecast twice a year. The line at the top was from our March 2022 forecast, when we predicted that in 2023, retail media would exceed $51 billion in spending and surpass $61 billion next year. Since our team published that forecast, Meta, TikTok, Snapchat, Pinterest, and Roku have all either gotten into retail media or have deepened their engagement with it. A couple more large retailers, including Dollar General, have gotten into it. A couple of large RMNs, such as Walmart, have allowed joint business partners to take some of that money and pour it into retail media. So why, with all of that continued momentum and continued buy-in from some of the ecosystem's biggest players, did we revise this forecast down by 12% for this year and 11% next year? So some of it is macroeconomic. We revised our overall US digital ad spend down over the same period. And that explains, I think, a portion of it. The other piece to consider is that this is fundamentally a new digital ad spending channel. It relies on shopper marketing and relies on search ad spending, but it is fundamentally new, and so there will be more fluctuation. But to me, that only partially explains what's going on here. So let's look at a couple of things that are slowing what's going on in what's already a very exciting channel. The reality is that retail media is, at the moment at least, evolving maybe a little too fast for both its buyers and its sellers. If you think about retail, the kind of atomic unit at the moment is on-site search ads. But for an advertiser who wants to go whole hog, retail media could mean search or display ads on a retailer's owned and operated website. It could mean display ads across a whole network of third parties that are partnered with the retailer. It could mean CTV. It could mean digital out of home. It could mean audio advertising. And that abundance of channels can create a lot of confusion and hesitation about where to spend. It also creates coordination challenges. So imagine that, again, an advertiser that decides that they've bought into the power of retail as a spending channel, and they decide that they want some CTV, they want some digital out of home, they want some audio. All of a sudden, when it comes time to coordinate that spending, they have to involve their social agency, their digital out of home agency, a creative agency to thread the messaging all together, maybe a performance and shopper marketing teams. And all those people are going to be busy jockeying with one another to have a say in how the spending is handled and who kind of has how much of their hands on the wheel. This is complicated in and of itself, but it gets even more complicated when you factor in the measurement problems that abound when you advertise in more than one retail media network. And as we'll cover a bit later, a lot of advertisers are in lots of retail media networks. I should say, just pause here, that I consider these to be speed bumps. They are not potholes. They are not sinkholes. They are not cliffs. A lot of these things will get ironed out, but I do think that they are dragging on the spending in the channel, however slightly. And I say slightly because the reality is that this is a channel that is growing very, very healthily. So we predict that this year, if you remember from a few slides ago, retail media will exceed $45 billion in 2023. That is more than twice what it was in 2020 when we began tracking this space for the first time. By 2025, retail media will account for 1/5 of US digital ad spending. By 2027, it will exceed $100 billion. That's impressive, full stop, no qualifiers necessary, but I think it's even more impressive when you factor in that we expect that the US digital ad economy is going to grow the slowest it's grown in 14 years this year. That's for a lot of macroeconomic reasons that we can talk about some other time, but the reality is that this runaway growth is happening in the context of a much more anemic, much more sluggish environment. So obviously this is great, but let's contextualize this a little bit further. How good is this good? So I think the best way to sort of think about it is to stack retail media's growth up against 3 other either very important or very hotly tipped ad spending channels. So the thing that should leap out at you from this chart is that retail media could wind up exceeding social media ad spending by 2027. I say could because 2027 is a long time away and a lot can happen in media in that time, but also because you'll notice that our social forecast cuts off at 2025. Our forecasting team evaluates spending in that channel over a much shorter time horizon. But the thing that's important to tease out here, which is only sort of apparent in the bars here, is that social is expected to grow very slowly by its standards over the next several years. It's going to have compound annual growth of about 7%, which is slower than overall US digital. And over that same time period, retail is going to be growing at, in excess of 20%. So again, this is a pretty profound trajectory for any format to be on, especially a new one. And if it gets there, it's going to be driven principally by one company. It doesn't take a rocket scientist to figure out that that company is Amazon. This year, they will account for more than 3/4 of the spending in this channel in 2023. That is down slightly and will continue to decline a little bit through 2025. But I don't want the people on this call to lose the forest for its biggest tree. Even if you take Amazon out of retail media, you're still talking about a field that will exceed $9 billion in 2023 and will exceed $14 billion in 2025. I should also point out that a lot of that growth is going to come from Walmart. They are the third largest bar on this graphic here, and their share will kind of continue to grow. To an extent, the share that they eat up will be the other bar, the second largest bar currently. Others' share has been dropping. It's growing, quite healthily, but it is dropping. And the reason that matters is that there are a lot of retail media networks hiding in that other segment. So this is a kind of, I wouldn't call it a LUMAscape, but it's a picture of all the different retailers that currently operate in RMN and are playing in this space. And you look at this and you see a really encouraging picture of how widely penetrated and how thoroughly suffused into just kind of the digital landscape retail media has become already. You have 8 of the 10 largest US e-com retailers on here. You have grocers, you have office supplies, you have pet goods sellers, you have healthcare companies. And as crowded as this graphic is, it actually kind of undersells the scope of the retailers participating in retail media. CitrusAd, which is owned by Epsilon, claims that 40% of US retailers sell some inventory through their pipes. And Criteo, who we'll hear from a little bit later, has its own network with nearly 200 different retailers in it. So now that we've sort of painted a picture of the size of the space and its players, we should talk a little bit about some of the external factors that are driving this growth.
And
so,
Max, sorry to interrupt, but just going back for a second to your comparisons with, particularly with social and CTV, which I thought were very illuminating. One additional comparison point that I could add there is that we do expect retail media by 2025 actually to surpass linear TV, which is quite a milestone when you consider what linear TV has meant to the advertising industry up until now and how fast retail media has grown.
I think that's a really excellent point of comparison, Paul. I mean, if you think about just how integral linear television has been, and to an extent remains, it speaks to how strategically important retail media has grown. It's not just kind of a whiz-bang, nice to have incremental spending area. It is becoming integral to lots of brands very quickly. But let's talk about what's driving this growth as well. So before we dive into the specifics of the channel, we should talk about sort of some of the larger tailwinds. Two of the things that powered the surreal rise of search and social were healthy continual increases in user penetration and user engagement. And there's a flavor of that at work for retail media as well. So this chart here shows the growth of retail e-commerce sales in the United States over the next several years. And the important number, I think, is the numbers that you see along the red line chart, which show that what we're looking at is rock solid 10% growth year over year for the next several years. Retail e-commerce is, aided largely by what happened in 2020, become a very, very big deal. More than $1 in $7 in US retail sales will be spent online this year. But thanks to this growth, which you see on this chart, it's going to be more than 1 in 6 by 2025. And a big factor driving that growth, frankly, are the people that are already doing the purchasing. We're talking about increased engagement here. So here we have a look at the e-com retail sales per digital buyer in the United States. And as you can see from the headline of the chart, that's going to grow more than 40% through 2027. And what you're looking at here, besides being a bar and line chart, is just a very, very enticing picture of target audience for advertising. The only way that I know of to get to $5,000 in digital spending is through lots and lots of transactions. So what you're seeing here is a picture of people who are comfortable transacting a lot and in lots of different places. And in the course of conducting those transactions, they are delivering more and more data to the retailers, which makes the targeting and delivery of the ads on those platforms more efficient and more accurate. And that's encouraging for everyone in the ecosystem, but I think it's especially encouraging when you consider just how much runway there is across lots of different spending categories. So our forecasting team tracks the retail e-com penetration in 10 different industries. And I pulled out these here to highlight the fact that there's just a ton of headroom left for a lot of really key digital spending categories. You think about food and beverage, which is going to be under 10% this year. Personal care is under 20%. And there is a very natural upper spending limit on lots of these. We're not going to get to a place where, 80% of the food that we buy is going to be purchased on the internet, but we're still talking about substantial runway that's going to fuel a lot of the growth that we've already talked about. So moving away from the macroeconomic stuff, we should talk a little bit about the formats that are really powering this channel at the moment. And before maybe we get to the what, we should talk about where. One of the things that's very important to realize about retail media is that at the moment it is powerfully dominated by on-site spending. So it'll account for over 85% of the retail ad spending this year. That share will decline slightly, but it will remain north of 80% for the next couple of years. It was north of 90% for a few of the years preceding this one. And it's important to underline that this is because of a couple of things. One, because of the sort of primacy of on-site search, and also because of the outsized influence of the two biggest companies in this space. So Amazon and Walmart have such gargantuan digital scale that they can basically continue to ramp up the on-site spending, and it's going to power the balance that you see in this chart. But as you sort of move further out on the long tail of this ecosystem into the other RMNs, where on-site scale is much more insignificant, relatively speaking, off-site spending becomes a lot more important. So as an example, Dollar General, which I mentioned earlier, they only get about 10 to 20% of their retail media revenue from on-site. The rest of it is off. And I think that that's going to be something very important to remember as we move forward. So now that we've talked about the where, we should talk about the what. As I mentioned before, search is the sort of dominant spending style for retail media. But the balance is tilting much more quickly toward evenness than it is in the on versus off. It'll be search is going to represent under 60% of spending in this channel by 2027. And you'll notice too that display is growing very, very healthily over this time. We'll get more into it in a second, but one thing to remember and contrast here is just how the black bar on this slide is growing a lot more quickly than the offsite was on the other one. That's because retailers are currently very hard at work in figuring out how to cram more display advertising onto their sites. That includes video, that includes display and retargeted units. And retailers are going to advance and iterate in this space a lot more slowly and deliberately than news publishers did 15 years ago. But there is going to be I would say, a significant amount of change in the sort of on-site experience for lots of digital retailers over the next several years. So before we get into display, I swear we'll get to it. I do want to do a quick sidebar just on search. So the reality is that because of how much interest there is among advertisers in retail media search, it is increasingly kind of driving the growth of search ad spending overall. This is happening partly because, again, of the intense interest in retail search, but also because search in general is becoming a much more atomized digital consumer activity. A lot of young people now begin their searches for things on places like TikTok or Instagram. If I am starting a to search for a specific kind of good, I might, go directly to a digital retailer that I know has it. And as search becomes more atomized, that is a benefit to retailers. It also hurts Google. So back to formats. Let's talk a little bit about what's going to sort of drive the evolution that we've talked about in the next couple of slides. Before we dive in here, I just want to do some sort of context setting as far as how important offsite retail media is going to be relative to just other ad spending channels overall. So here we have offsite retail media in red compared against two other digital ad spending formats, one being influencer marketing and one being digital audio ad spending. This year alone, offsite retail media is going to be bigger than all of influencer marketing. By next year, it's going to be bigger than all of digital audio ad spending. So even with, on-site being a dominant source of spending, offsite in and of itself is going to be a force to be reckoned with. And I would say there's a lot of different formats and a lot of different, strategies that are informing that growth. But at the moment, the very biggest one is paid social ads powered by retailer data, and in some cases, retailer accounts. This is data that I got from a report that Sky published a few months ago, and it shows social media narrowly edging out a whole host of other ad formats that they are most interested in spending in. These are retail media advertisers, I should say. And this tight cluster, I think, really underscores that there are lots of different ways that advertisers can see retailers' data helping them target more effectively. And I bring this up not only to highlight the importance of social, but also to sort of call out two other formats where the hype and reality haven't really lined up. And those are CTV and in-store retail. So when I first began writing the report that this presentation is based on, I expected to hear nothing but talk about CTV and how kind of pivotal and important it would be to retail overall in its future. And the reality is a little bit different. So retail CTV is going to grow, and it's going to grow fast, but it's doing so from a small base and is going to remain under 10% of retail media display ad spending through 2025. It will account for a much bigger share of CTV, to be clear, but the idea that CTV is going to be sort of an integral piece of retail media spending is just not the case, at least in the near term. And the other one is in-store and out-of-home. I think these are really interesting to practitioners for lots of reasons. One being that it's very exciting to digital out-of-home folks who are eager to see that space continue growing. And also because I think it is easy to sort of visualize all of this changing an experience that's very familiar to us. You imagine going to a grocery store, for example, and maybe the end caps are now little screens, and maybe you've seen some video display over the cooler that contains your eggs and milk. And so it's very easy to get caught up in kind of the implications of what that means, that that's part of the experience. But as you can see from the lines on the bottom of this chart, it's going to remain under 1% of retail media ad spending overall. So I think while we're on the subject of hype and reality, we should talk a little bit more about some of the kinks that I mentioned at the top of this presentation. The first is that the number of retail media networks that advertisers use keeps growing. There's sort of a glass half empty and a glass half full way of looking at this. The glass half full version is that this is proof that advertisers have kind of comprehended the value of retail media ad spending and are just going to the places that they think spending would be a good investment. Last year, the Trade Desk asked a similar question of retail media advertisers, and they found that just 15% of brands used more than 4 RMNs. And as you can see from this graphic here, this year, 56% use more than 5, and 16% say they use more than 10. Now, the glass half empty version of this is that it is very difficult to evaluate the incrementality and incremental value of some of these RMNs and to it's hard to evaluate them almost in a vacuum, but it's very difficult to compare them as apples and oranges, or as different pieces of fruit in a bowl. And this is especially true when you think about the metrics that advertisers are using to evaluate retail spending. So this is data that was put together by Merkle at the end of last year. And they found something very interesting, which is that more than half of retail media advertisers consider it to be upper funnel ad spending, which in and of itself is odd, but it gets weirder still when you consider the metrics that they use to evaluate it. I mean, you see incremental sales leading the pack, return on investment coming in a close second. And this confusion stems largely from the fact that a lot of the retail media networks at the moment are getting to grade their own homework. There is no third party that has been sort of agreed upon as the arbiter of truth here. And so that's going to be a challenge, I think, moving forward. And one that I think, to be clear, will get ironed out, as things often do with emerging ad formats, but it's something to keep in mind.
And Max, how much of the sort of inflation in the number of retail media networks that marketers are using comes from the fact that there are just simply so many more that have come into the space? I mean, there's just been like an explosion. So is there like just a curiosity factor to check them out, or is there some sense that like there's a sweet spot, magic number?
I think that it definitely helps that there are more RMNs now than there were in 2021. But I think that it also just speaks to how nice and on its face effective a lot of this ad spending is. I mean, if you're being a very pragmatic advertiser and you're confining all of your RM spending to sponsored search, it's very easy to draw a clean line between, I am selling camping stoves and I am buying the keyword camping stove and, watching to see if people click and then buy. If I can generate a positive ROAS on that, I'm just going to keep looking for places that offer me that opportunity. And as you saw from the Merkle slide, there is no shortage of places to see if that opportunity exists. So a final thing that I want to just leave you with here is a look at just sort of what the opportunities are here. So these I think apply both to buyers and sellers, and even middlemen, if there are any out there in the audience. So one of the important things to focus on, whether you're selling or buying, is just to simplify access. As I mentioned before, if you're a retail media network and you offer CTV and you offer digital out of home and you offer third-party digital in addition to on-site options, you have got to find a way to simplify access for the folks that will come in and buy that inventory from you. And moving on to another thing that you have to think really hard about is just how you solve for measurement. Because there isn't, again, that sort of universal source of truth, you just have to work within your organization to come up with a pragmatic lens to view retail media spending through. And finally, I think the most important thing here to point out is as someone who spent a long time working as a reporter, I am not someone who likes the idea of cheerleading or rah-rahing any kind of ad spending, but I think that this is a space that is growing so quickly and so powerfully that if you are, someone who spends any kind of budget in digital media, you have to kind of get into retail media and figure out how to make it work for your organization. The opportunities are really pretty numerous, and if you wait until all of these problems that I alluded to, and like I said, there aren't even that many, but if you wait until they all get ironed out, you're going to wind up missing out on some, I'd say, easy opportunities. So that's one kind of note that I would leave you with.
Okay, well, that was great, Max. Thank you so much. And before we get to your questions live, we've had some good ones, so please keep them coming. I'd like to bring back our special guest from Criteo, Michael Greene, Senior Vice President, Global Vertical Strategy. Welcome again, Michael.
Thanks, Paul.
So lots of great material to go over here, and really looking forward to your insights. So on our last retail media ad spending forecast webinar, We spoke about how Criteo was seeing growth consistent to what we were seeing. Are you still feeling the same? And how does Criteo's growth compare to more mature retailers like Amazon and Walmart?
Yeah, absolutely, Paul. I think much as last time we spoke, we're seeing consistent growth, much aligned with what you at Insider Intelligence are seeing today. Even in an uncertain macro environment, we're continuing to see that brands and agencies are investing in retail media channels, and that retailers are increasingly getting in the game, expanding their offerings, and making themselves, to Max's earlier point, simpler than ever to access. So consistent with your forecast, we expect a long trend of growth in the space and see significant upside for all participants. As we look at kind of retailer allocation of spend, I think what we're seeing is completely consistent with what you see in the forecast. Advertisers are spending on more retailers than ever. Many of the brands that we're talking to are asking more and more how they can further diversify their spend outside of some of their biggest retailer partners. And I think that's one of the reasons that retailers in our ecosystem are seeing growth higher than some of those larger peers that you mentioned earlier. And I think that's a trend as those retailers open up their offerings, add more ad units, become simpler to access than ever before, is bound to continue. So we're obviously incredibly bullish on the space and really excited to see how it continues to evolve.
And Michael, we shared that existing advertisers will account for a substantial share of the market growth. So have big brands found the right budget levels for retail media? Do you have any learnings there?
Yeah, not quite. I think it's a problem that everybody's continuing to work through in their own way. I think if you listen to a lot of industry commentary, people will float everything from 3 to 5 or 5 to 10% of GMV as the optimal budget level for retail media. But I don't think a lot of that is backed up with fact and science at this point, more gut feeling and rule of thumb. And there's a lot of complexity inside many brand organizations as they look to navigate an increasingly complex world of trade spending, shopper marketing, joint business plan commitments, as well as new incremental retail media budgets entering the fray. I think one of the biggest conversations we're having with most of our branded agency partners is how does the planning process need to evolve to account for all these new opportunities? I think we're entering a world where every brand knows that they want to optimize what they do, not just in retail media, but their overall media allocation towards driving commerce outcomes. But the planning tools they have today are based upon other types of metrics that may be more traditionally considered upper funnel, reach to target audience, in demo targeting. And while these things remain important, I think the value of retail media has really been about its ability to get to what ultimately matters to brands, which is moving products off the shelf. But the planning tools haven't quite caught up there. I think we're going to see significant evolution this year. There are a number of companies in the space, including ourselves, who are investing heavily in this area. And I know our brand agency and retailer partners are all eager to make progress in this space.
So Michael, were you surprised by the data showing that 54% of brands see their retail media spending as upper funnel? And does it feel right that CTV was still less than 10%?
In terms of brands seeing it as upper funnel spending, I was a bit shocked, to be honest. I think consistent with what Max mentioned, I think it's a combination of a couple things that surprised me. One, if you look at it from a media tactics perspective, consistent with your data, we see spend still heavily concentrated in search or what we call sponsored products at Criteo. Traditionally, that's been bought by performance-oriented buyers, search buyers, and these things have traditionally been considered fairly lower funnel as tactics. Similarly, consistent with the point Max raised, the metrics are very much about driving revenue performance. And I think that speaks to what a trend we see of collapsing of the funnel. This distinction between what's an upper funnel tactic, what's a lower funnel tactic, I think really becomes almost academic as you get into a world where you can measure everything against sales results, and especially with the rise of offsite retail media. And I think CTV is just one component of that. I think this notion of brands looking for performance, regardless if that spend is done on a retailer site, through programmatic, in CTV, in social, however they buy, is a trend we're going to see continue, because ultimately brands are in the business of moving products off shelves, and they're going to want to leverage the same types of measurement capabilities that they've come to enjoy through their on-site retail media, but just across the broader set of their media spend. On CTV in particular, I think its low share of wallet is not a surprise at this point. While it's a channel that we hear significant amount of interest from brands and agencies, and we continue to test and support, it remains a bit difficult to access, at least at scale in many cases. There are a host of technical challenges in the space that still need to be resolved around things like user matching that are essential for providing the kind of closed loop measurement that brands expect in the space. I think as we begin to solve those problems, simplify inventory access, and make it simply more streamlined to combine with the wider array of retail media tactics, we'll see it grow. But I think it's early stage of retail media, and the data reflects that.
Yeah, just as a side note, last week I spoke on a panel at the TV of Tomorrow conference, and it was a panel on retail media and the convergence with CTV. And I think the general consensus was similar to what you expressed and what Max showed. So in the last question we have before we get to the audience Q&A, let's talk about offsite. So this has been a big focus area of Criteo's over the last year. So can you tell us why?
I think for a lot of the reasons that were mentioned on this webinar, right? It's of high interest to retailers in terms of opening up an incremental revenue stream. But more than that, for brands and their agencies, I think they know it provides reach and scale and is money they're going to spend anyway. And if they can bring retail media style targeting and measurement into that channel, it's a no-brainer. And I think a lot of the numbers that we see in our testing we've done with brands bear this out. We did some testing in Q4 with clients and saw that when they were combining off-site retail media tactics in combination with on-site retail media tactics, they saw 125% increases in conversion rates and 57% increases in order value from customers that were exposed to both off-site retail media and on-site retail media, as opposed to just on-site retail media in isolation. So I think this idea of driving consumers through the shopper journey from product discovery to inspiration all the way to purchase points towards a greater role for offsite retail media. But additionally, I think as marketers get more focused on things like incrementality, increased share of category, they're going to need to look beyond just the point of sale and find ways to leverage the power of offsite retail media to expand their reach, but also drive some of that more deeper incrementality that they could through onsite tactics alone. We're seeing significant interest here, and I think the real unlock is going to be as we bring these tactics closer together and make them easier to work with in coordination, we're going to see more and more spend flood into this space.
Great. Well, thank you, Michael. Now it's time to get into our audience Q&A. We've received a lot of great questions. I'll start with the first one, I think for Max, but Michael, you're welcome to chime in as well. What are some risks that advertisers and retailers should be aware of?
So I guess I'll jump in and say that it's something that I alluded to in my earlier remarks, and that's the potential to, disrupt or pollute the on-site experience in a way that potentially turns off consumers. I mean, I think that, like I said, retailers are going to be a lot less cavalier about this than publishers were, where they couldn't resist that just one line of JavaScript, opportunity to maybe add a little bit more revenue to their sessions. But, there is this possibility that, visiting a retailer's website to buy something becomes a noisier, less convenient, more unpleasant experience, which, is this kind of tragedy of the commons that maybe turns a lot of people off from buying things online. And, again, like, I don't think it's a high likelihood, but it's something that I think a lot of retailers are going to have to think really long and really hard about when they consider how much inventory they can really cram into their O&Os.
Yeah, Max, I think one of the things that we consistently see in our business is that the retailers that we work with, at least, are obsessive about maintaining the customer experience as they grow their ad businesses. It's one of the reasons that they work with us as kind of a native to retail media technology company, as opposed to a company that's come from more traditional media and entered the retail media space. Because I think merging revenue streams between selling products and selling ads is a tricky one to get right. But retailers at the end of the day are always going to prioritize that selling of products is the core of their business, is their core competency, And unless they do that, they don't have an ad business to fall back on. So I think they'll go cautiously. What I expect to see going forward, though, is a lot more scientific rigor from retailers as they think about site design and how they integrate ads into it. One thing we've seen a really sharp rise in over the past few years is retailers are rigorously A/B testing virtually anything that they do. That could be adding new placements, loosening up what they call relevancy rules. That's basically what ads can serve where in their site, and trying to understand the holistic impacts of those decisions. I think going forward, what we're going to move from is a world where those are set with kind of predefined business rules that are done through 6 or 12-month testing increments, and move towards something that's more AI-driven, personalized, user level, where optimal ad load, type of ad, format, advertisers even is going to differ for you, Max, versus me, based upon our purchase intent, our value to that retailer and to that brand, our lifetime value to that retailer. And we'll end up with some much more optimal personalized experience that really optimizes overall revenue for that retailer across product sales and ads. It's one of those tricky second order problems to solve as retail media scales. But I know all our customers are thinking about it right now, and we're here to help.
So we got two related questions. So I guess I'll throw it out to both of you as a two-parter, and I'll start with you, Max. What is the relationship between social and retailer? And the second part is, can you share an example of how retail media could be used to target a social campaign?
So I think that the really exciting answer to this question is we don't really know yet. Retail and social media have this potential to be, potentially quite symbiotic to one another, potentially, more parasitic, but it's all sort of to be determined. But the reality is that for a lot of reasons that we don't really have time to get into, social platforms are suddenly sort of in reckoning with signal loss from ATT, or sort of, and also having run out of lots of easy user growth, are looking about for partners that can kind of help them, just continue to drive spending on their platforms. And I think that, between things like the drive toward an embrace of short form video, the potential for, live stream shopping, which everyone seems to very committed to believing in, even though I personally don't see a lot of upside there. There's a lot of possibility for the two platforms and the two spending channels to work together really nicely. And I think sort of a key way that they potentially work together, I'd like to hear if, maybe Michael knows more about this, but, just the possibility of sort of, audience extension, of sort of, taking the people that fit a certain, demographic or criteria from a retailer's first party data, and using that to target them with the retailer's accounts across social platforms is a pretty open and easy, extension there.
Yeah, Max, I'm a big believer in this opportunity. I mean, I think brands have seen for years the value of social as a high value inventory space, massive reach, high levels of engagement. But I think they're coming to expect the same levels of measurability that they have from their retail media buys, specifically looking to kind of attribute everything they do in social to ultimate sales results. I think, if you look at how this stuff's been executed in the past, there have been a lot of one-off tests and trials. But I think specifically around connecting transactional data to ad exposure in social environments, there have been a whole host of technical hurdles that have been tough to overcome, especially given that you're dealing with two very sensitive data assets. One, a social platform's user data, which is subject to tons of regulatory scrutiny, rightfully so, and a retailer's very valuable transactional data. I think with the advent of new technologies, especially things like clean room infrastructure, we're getting closer to a point where we can begin to join those data sets at scale in a privacy safe way, and begin to bring the type of measurability you have in, say, on-site retail media into social. We're in conversations with many of the players in the social space that you would expect around those. I think there are really exciting opportunities there. And I just say, watch the space. I think there's going to be significant movement over the next 6 to 12 months as technology players like ourselves, retailers, brands, and the social platforms all look for ways to bring these two things together, because brands are going to still want to invest in social, but need the type of lower funnel metrics that they get from retail media, the performance outcomes, to continue to justify high levels of investment.
I think we have time for two more questions. So Max, as our expert on publisher ad monetization, question is, can publishers get involved in any way?
So I think that there's potential for some more than others. It's funny, speaking to to some publishers late last week, I mentioned retail almost in passing, but it became clear that this is an area of really top level interest from them, because what they see beginning to happen is really rather resonant with what they saw happen with search and social many years previous, where there's this skyrocketing increase in spending that on the surface at least they have no kind of entry point into participating in, right? They don't have the scale of a Walmart or an Amazon. They don't have the data that any of those players do, and so they're worried, very, very worried that they could wind up on the sideline here. But I think that when you think about the kind of offsite extension that a lot of RMNs are really, exploring very intently, there is going to be an opportunity for publishers to have, a slice of cake. It'll be a slim one, but I think that if they have an open mind about figuring out how to do that, there's some possibility there. There's also potentially too, an opportunity as these retailers rethink the kind of user experience and customer experience on their sites for publisher content, for example, that maybe helps people get over the line. Amazon explored this for many years with on-site associates, where they would take kind of buying guides from publishers like Wirecutter or CNET and embed them in search results to sort of see if it helped drive more conversions. And I know a lot of retailers have kicked tires on something similar, and so it'll be interesting to see how that kind of manifests in the years to come, both on and off retailer properties.
Great. And the last question, I think, is one that you both might have some viewpoints on. The question is, who is solving against attribution across all these RMN silos? And I think there's the thought that there's a lot of inefficiency across RMN platforms.
I guess the reality is that we're pretty far away from there being one company that's even emerged as kind of a front runner for who can handle this. One of the things that we've all been sort of talking about directly and indirectly throughout this session is just how sensitive a lot of this data is, and finding a third party that can kind of come in and measure against that stuff is going to take some doing. And so I would say that there isn't sort of an early front runner in the space at the moment to sort of solve for this challenge.
Yeah, Paul, to that point, I think one of the reasons brands opt to work on Criteo's platform is the normalization of measurement across the 200 retailers that exist in our ecosystem. That being said, there are clearly gaps there. You have retailer walled gardens that don't exist in our ecosystem today and grade their own homework in a very different way. I think the challenge is going to be, you're going to land with a few large gardens in the space. How you join and normalize that data together probably requires some larger scale industry collaboration that's going to help really set the stage for brands to have a more normalized look at this data, because I don't think we can see scale of spend without it. It's one of the reasons that we've been so committed towards not operating purely as a builder of retailer walled gardens, but as somebody who can build an ecosystem with standardized targeting, campaign workflows, and measurement. Hard to see the scaling without that.
Well, having spent part of Memorial Day weekend working on my own garden, it was a lot more than I bargained for, and I don't even have a wall around mine. So big challenge right across the board there. But unfortunately, that's all the time we have for today. So thanks again to Max for joining us, and a very special thanks to Michael and to the team at Criteo. Our eMarketer production crew behind the scenes also deserves a huge thank you for making this webinar possible. And as promised, we'll be emailing you a link to today's slides along with a full recording of the session. So keep an eye on your inbox for that. And before we wrap up, let me just take a moment to tell you what's happening across eMarketer's media channels. We're thrilled to share that we're hosting another live virtual attention summit taking place this Friday, June 2nd. So mark your calendars. You can register for the summit and for upcoming live analyst and tech talk webinars at emarketer.com/webinars. On the audio side, don't forget to tune in to Behind the Numbers, eMarketer's daily podcast, which you can find anywhere you listen to podcasts. And finally, please check out our newsletters. We have a couple of options across retail, finance, and digital advertising, so there's something for everyone. If you haven't already signed up, you can do so at emarketer.com/newsletters. Thank you again for joining us, and enjoy the rest of your workday.